nominal interest rates of 4 to 5% so they can live on their retirement savings without a nominal invasion of principal. That psychological benefit is not in the GDP statistics. As a matter of fact, you reduce the GDP statistics because they're not going to psychologists and spending money, which would construction depress the economy. The other thing is that if you act too soon and you decide, oops, we acted too soon, you put yourself in a position first where you have a zigzag policy, and you will face criticism from that by some people I know. And second, if you then want to go in the other direction, you only got a quarter point to play with. So if you hit the brake too soon and just say, oops, I got to hit the accelerator, you don't have any gas. With that in mind, I'm concerned about the effect raising interest rates now would have on the real estate recovery, and I would ask you what you would think the impact would be of raising interest rates on the housing recovery, and would we squeeze creditworthy borrowers out of the housing market and create a negative feedback loop with prices going down?
So you've made a large number of very good points and indicated many relevant considerations that the committee is trying to weigh and balance and has been taking into account. With respect to the housing market, of course, the level of mortgage rates is relevant to housing, and so we're very aware that, for example, a sharp rise in mortgage rates could have a very negative effect on housing. We do, however, have a recovering economy where employment is going up, income is going up, households are in better shape to form households, whether it's that they're moving into rental properties. The millennials seem to have a strong preference for later house purchases, but we do envision gradual recovery in the economy, in the housing sector. Let me come back to the point that I made earlier, which is the committee anticipates a very gradual increase in interest rates. We're not envisioning that when we begin to raise rates, we're going to be looking at a very steep path of interest rates that would cause the kind of harm that you're worried about to the housing sector. So that whole path matters. And
the time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of the Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. It's always interesting to listen to the gentleman from California. He's a very bright guy with lots of interesting correlations, but I've never heard of God's plan for the seasons correlated to the Fed's plan to raise interest rates. I enjoyed the discussion this morning, gentlemen. Welcome, Chair Yellen. This morning I want to talk a little about the designation, a SIFI designation of insurers. Very concerned that FSOC and the Fed have become the rubber stamp for the Financial Stability Board. It's my understanding that the FSB made the designations for global, systemically important insurers without extensive analysis or information from the companies other than what was publicly available. So my question is that the case? And if you did not receive information from the companies, how did you reach the conclusion that they posed a risk to the global system?
well, Congressman, in the case of the companies that were designated, in every case there was an extremely detailed evaluation that was done, and a summary of the evaluation is publicly available that did involve interaction with the company.
Excuse me, did the analysis so come from FSB, or was it your own analysis?
This was the analysis of the FSOC.
FSOC.
The FSOC and its staff prepared very detailed assessments of what the consequences would be for the U.S. financial system of the failure of one of these firms.
You know, it's interesting. That's not the question or the answer that we get from the insurance side of this, from the company side of this. Did you solicit any of this information, anything from them, or did you just take FSB's information and take that and try and analyze that?
We have detailed interactions with the companies.
You got information from them outside of what's publicly available?
Absolutely. I mean, part of the designation process, in stage 3 of the designation process, there have been detailed interactions with the companies. They have provided information. They've had every opportunity to weigh in and to offer their views of.
It's kind of, if I can interrupt just a second here, it's kind of interesting, though, that the one individual on FSOC who has some insurance background is the one who said, no, we don't need to designate them as systemically important, yet FSOC went ahead and did it. Can you enlighten us as to why that would occur? Why did the other folks who are not experts think that they needed to be designated, where the expert said, no, we don't?
Well, we have a great deal of expertise in insurance on the FSOC and among the staff who look at this. And what I can assure you of is that very detailed analysis was done, firm-specific analysis of what the consequences of a failure would be, and the firms had ample opportunity to weigh in, and they very well understand what the logic was of why they were designated.
All due respect, Chair Yellen, I'm not sure that they had plenty of time to respond, because now they're going to court to try and resolve the situation. So I think if they could have responded to this, surely there would have been an ongoing discussion that could have minimized this, and they wouldn't be going to court. They would have agreed with the analysis or agreed with your designation. But
Well, they may disagree, but